And now it gives me great pleasure to welcome Sam Vesht and Emily Fletcher.
Good afternoon, everyone. Thank you very much for being with us today. Hopefully you can hear me and see the presentation. It is Sam Vesht here. And in a slight break from tradition, we're going to encourage questions at all points that Emily and myself will try our best to answer. So we would love to have lots of questions. It's late in the afternoon and far more interesting than listening to myself and Emily talk for long periods of time. We are much more excited, and I think humanity would be much more excited by listening to questions that we can try and answer rather than us give our presentation. And thankfully, we already have one question in, but we're not going to answer it straight away. I just want to kick off looking at the slides just to remind people what this fund is all about. So if we go to the next slide, this portfolio invests in a range of countries and in a series of companies that benefit or do business for 3 billion of the world's poorest people. In a world that is oft focused on ESG, and lots of people are interested in how they can improve their investments impact on the world, we think it's quite useful to focus to think about how one can invest in a way that indirectly has an impact on the world's poorest people. And it is a fairly sad fact that over the last 10 years, while lots of people have become increasingly focused on matters ESG, the percentage of people's portfolios invested in emerging and especially frontier markets has actually fallen. We find that slightly surprising, but it's nonetheless true. The percentage that people have invested in frontier markets is somewhere between 0.5% and 1% of their overall asset base, which strikes us as pretty small compared to the 3 billion people that represent a pretty impressive opportunity. If we go to the next slide, and the one subsequently, hopefully, let us focus on what frontier markets offer. They're about 30% of the world's population, as we highlighted earlier, 10% of the world's gross domestic product. But as I said at the beginning, only 1% of world indices, down from about 1.5% a few years back. There are long-term structural opportunities here. Every thematic opportunity that one hears, or almost every thematic opportunity that one hears about in the developed world exists, but in a quicker and more exciting form in frontier markets, whether that's rapid urbanization, whether it's emerging global wealth, whether it's digitalization. There are an enormous number of opportunities within emerging markets, and especially the frontier market portion thereof. And if we just go on one further slide before I hand over to Emily, whether it's investing in EV materials in Latin America, whether it's in diagnostic healthcare in Africa, whether it's really looking at the supermarkets of the future or meeting retail needs of the future in Southeast Asia, our fund invests in all of these. And just as a reminder, what these colors on this presentation show you, we have tried to color code the different countries that we invest in, the light green ones being in Latin America, the purple-ish ones being in Africa, quite a lot in the Middle East, and then quite a lot in emerging Europe and in South and Southeast Asia. And over to Emily.
Fantastic. We can move to the next slide. Thank you. Now, it's kind of an interesting slide you have chosen to show in a way, because obviously in the last 2 years, we haven't been able to spend a lot of time on the ground. But excitingly, as of Q4 last year, we have been able to do a little bit more travel, and we're hoping to be in the Middle East next week, having been to Egypt, Kazakhstan, for example, in the fourth quarter. What I really wanted to highlight here was that across frontier markets, it's actually a large universe that's quite hard to cover well. Sam and I have been working together on this product for about 15 years. And over that time, we've got to know a number of companies across, obviously, quite a few different countries. I think it's important here to state that we don't invest in any company that doesn't have a fully audited set of accounts. So that would be a P&L, a balance sheet, and a cash flow statement. And even in these countries, they would typically be audited by a subsidiary of the Big Four. And then it's really important to stress the amount of time in a normal period that we will be spending on the ground, that we've been recently spending on Zoom, but really getting to know these companies, their suppliers, competitors, all range of companies within the markets. And we really feel that the longevity that we have, sadly, and the grey hair we've earned investing in these companies is really important. Please, at this point, I just want to say, please do keep asking questions. I know we have one on the screen that we haven't answered, and we will obviously answer that in a couple of slides' time. But please do keep asking questions, and we really want to make sure that we're directing the presentation in terms of what will be helpful. If just the other thing to say, I think, on this slide is really the depth of team that we have at BlackRock. We work on a team of about 30 people across 30 investors across emerging markets. We think this is a fund that would be pretty impossible for us to manage if we just left BlackRock and went to set up our own fund management firm. Fletcher Vet Capital would find it really difficult to get the same corporate access, to be able to have the same depth of contacts, depth of meetings across these countries. Particularly when investing in frontier markets, it's really important to have a holistic view, I think, of what's going on the macro side, the political side, the currency, fixed income markets, in order to be able to invest in these companies. To answer perhaps one of the questions, which I know is not the top one, but to answer one of those questions, to what extent do people speak English? It really depends on the country where we are. In some countries, a lot of people speak English. Somewhere like the Philippines, countries like Vietnam, there's many fewer English speakers. And we would potentially use translators. And actually, one of the things that's been brilliant about Zoom is the ability to have simultaneous translation, and we do use that a lot.
Obviously, just following on from that, the fact that we have a very broad team means that the number of languages we speak on the team is far more than if this was just sort of a two-person operation. So we speak a lot of the languages, obviously not every single language across frontier markets, but the vast majority of our interactions are in English, and the vast majority of companies we invest in report audited accounts by one of the Big Four in English, and typically slightly quicker than their Western counterparts, because most of our companies report results within a month of the end of the quarter. Back to you, Emily.
Thanks, Sam. If we move on to the next slide, you can just see the analyst stock ratings that we have. It's a slide that we're quite proud of, and again, I think just speaks to the depth of coverage on our team, that we are able to cover such a wide range of markets. Just to give a couple more slides, I think if we move on to the next one, this is perhaps some of the reasons why we think the markets are interesting at the moment, and this is really one of them. So frontier markets can be quite large exporters of commodities. At the moment, commodity prices have been doing really well. That provides a lot of support for currencies across frontier markets. And Indonesia is a really good example of that. And particularly in Southeast Asia as well, we really haven't seen the same recovery from COVID that we have seen in the rest of the world. So these economies are only just starting to get going again. So in a position of seeing the very strong earnings growth from here that we've seen in developed markets over the last 12 months. So economically, we're seeing a lot of the position that these countries are in is quite supportive for the outlook from here for frontier markets. If we move on to the next slide, this is giving some sense of the valuations that we're seeing across frontier and emerging markets. You can see that frontier markets still trading very much at a discount to what you would expect in the rest of the world. Obviously, that is to be expected. These are more risky countries to be invested in. But I think really goes back to what Sam was saying at the beginning. The question is, how much of a discount do they deserve? Over the time that we've been running the trust, we've seen the countries within frontier markets, we've seen the entire index continue to derate, so continue to trade at cheaper and cheaper valuations, which is in very stark contrast to what we've seen in developed markets, such that valuation gap is really at some of, I think, the widest levels it's been since we've launched the trust. And that's would suggest that there's something going on with the earnings of these companies that is problematic. And that's really not what we've seen. In aggregate, we have continued to see 10 to 15% earnings growth, sort of as we would expect, nice underlying progression of earnings growth from the companies that we are invested in. I've been speaking for a while, so I'll hand back to Sam to go through the next couple of slides or to answer a few questions.
Yeah, and I think that point about earnings growth is really critical. What is exciting about frontier markets is not just they're growing faster than the developed world, it's that the companies we invest in can grow earnings on a sustainable basis by 10 to 15% without any financial chicanery. They are in parts of the world that are growing faster, and they have access to portions of the market and sectors of the markets that are naturally growing. And so the combination of faster growth should, over a pretty challenged decade, have led to a higher rating, but that's not been the case. I think the big surprise of the last decade or more of running this trust has seen the derating, as Emily said. The next slide shows something interesting, which is that although we invest in ostensibly risky countries, Argentina, Philippines, Vietnam, Kazakhstan, all these countries, and we're going to talk about them in a bit more detail in a second, when you put them all together, these markets are surprisingly low in volatility, lower volatility than the S&P, lower volatility than the FTSE All-Share, because the investor bases are not the same. There is not just one investor in London or New York who looks at Bloomberg and gets worried and they sell everything on the same day, or they put a big sell program on. The people who invest in Argentina do not invest in Kazakhstan. So when Kazakhstan collapses, as it did earlier this year, because of a potential coup, it had no impact on Vietnam and no impact on Argentina and no impact on Greece or on any of the 25 other countries we invest in. These are little markets that have typically domestically driven share prices. And therefore, although each of these markets by themselves are volatile, when you put them together with other markets, they are surprisingly not volatile compared to broader stock markets. And if we go on to the next slide, something else that's interesting for us when we think about frontier markets is just the amount of cash they throw off. Unlike lots of Western markets, these companies do not and have not had people throwing money at them in the era of zero interest rates. And because people haven't been throwing money at them, they have not been investing poorly. One of the unfortunate aspects of people giving money for free is that companies then invest it really badly. In frontier markets, capital has never been free. Therefore, capital has to be conserved, has to be looked after, has to be cherished. And therefore, companies feel a need to pay dividends to keep shareholders enthused. And that's why, although we are not an income trust at all, we've been quite impressed by the amount of cash generated by our companies. And even in the last few years, where the last year or so, where there has been obviously problems with COVID, the dividends that our companies have generated that we then pay out to shareholders have been pretty substantial. We have a question about, are there any plans to move to a quarterly dividend distribution policy? Obviously, that's a matter for the board. We have paid biannually since inception. We find that's kind of what many people expect us to do. But obviously, if there are demands for us to pay quarterly, I think that's something the board will be best positioned to take account of. If we go on to the next couple of slides, just to look where we are investing, and this is really quite a beautiful pie chart in our eyes, really a very broad range of countries in different parts of the world. Obviously, we have a significant exposure in the Middle East, a significant exposure in Southeast Asia, but also exposure in Africa and in Eastern Europe, and a whole collection of countries that probably many of the people on this call haven't necessarily thought of as great investment destinations. They are great investment destinations because fairly few people are looking there, and therefore our ability to invest there and add alpha for clients is just that bit higher. So we're very excited about the outlook for almost all of these countries. And the other great thing about investing in these markets is that we don't need to be anywhere. We are not a Saudi Arabia fund that if there was something terribly wrong in Saudi Arabia, we still have to pretend we like Saudi Arabia because we have nowhere else to go. We do like Saudi Arabia. At the moment, we're fully aware of the economic and political challenges and social challenges of that country. But we're very keen on that market today. However, if there came a situation where we didn't want to have any money in Saudi Arabia, we don't have to have any money in Saudi Arabia. And in fact, there are countries that do not feature today at all on this pie chart that historically we've had very significant weightings in. We've had over 10% in Nigeria. We've had over 10% in Pakistan. We've had a very large weighting in Turkey. And all those countries are really de minimis today, or not there at all. And that's because we are not tied in to any country. We trade only in stocks that trade every single day. There's no mark to make believe, no level 3 asset, no pre-IPO situations. So for us, what's really important is the fact that as much as we love some of these countries, we're also aware that there are challenges in these countries. And if something goes wrong, either with politics, macroeconomics, fixed income or currency, we can get out. We are not there forever. We love our companies to bits while we own them, but we are not there forever. If we go on to the next slide, and this will help me answer one of the questions that has already popped up. We optically have a large weighting in financials. That's not because we have a broader great love of financials, although we find nothing wrong with financials today, especially in an environment where interest rates are going up around the world. But it's really important to understand that financials in our markets are unlike financials in the Western world, because you could look at JP Morgan and Credit Suisse, which obviously are listed in two very different geographies, but ultimately they're both global investment banks catering to very much the same world and facing the same political, economic, regulatory challenges. However, when it comes to our financials, that's not the case. So we may own financials currently in Saudi that operate purely in Saudi. We also own a Kazakh bank, and we may also own financials in other countries, but they do not compete with each other. So what's much more important for any of these individual financials is the macroeconomic environment in their own specific country. And therefore, we have a large proportion in financials. They are growing, they are cheap, they reflect increasing democratization of finance. There's digitalization that's going on there, which is really exciting and therefore generating long-term growth, but they do not come with the same challenges that financials in the UK or the US come with, i.e. structurally zero growth, structural problems at low interest rates, structural declining NIM, and structural increasing competition. So although the sector is the same, the challenges are very different. Back to you, Emily.
Yeah, thanks, Sam. I think the other thing I would add on financials is that a lot of what we do is just invest in very simple banks that take deposits and make loans. It's very different, again, to what we see in the Western world. And there, where we are seeing interest rates go up, there is a significant benefit to earnings, which is just very anti-expectations in our countries, because they haven't seen anything like that happen for such a long time. So if we move on to the next slide, I think this is giving you the top 10 in the portfolio, but what we'd really like to highlight is the flags on the left-hand side, and really just the variety of different investments that we find around the world and the number of different countries that we're invested in. You can see it's quite a diverse portfolio, with the largest weights being up sort of high 3s, 4, 5%. And we really like to have that diversification in the portfolio. There's quite a number of different companies that the fund is invested in. If we move on to the next slide, you can see performance over the past few years. Obviously a slide we need to show. As we have mentioned already, I think one of the things that we've been most disappointed in since we launched the trust is the derating that we've seen in frontier markets. I think we believe that we've been right in terms of the earnings growth that we were expecting and seeing that come through. But I think that the derating has obviously not helped performance. And that's something that we would love investors to come and realize, investors who aren't here, who don't know about the trust, the global world of investors, to going back to that 0.5 to 1% of portfolios that are really invested in these countries, is to come to see the value and the benefits of these markets. And if we move on to the next slide, that's really sort of trying to bring together everything that we've been saying. I think that there's a lot of investors globally who are really looking for growth in a world where maybe not in the next few years, but longer term out, that medium term horizon, are concerned about the growth that the world can generate. But actually in our markets, we still believe that we have very strong structural growth, good population growth, and that real need for infrastructure that can give you endogenous growth. But actually at the same time, I think we're one of the trusts that still offer the higher end of yield. And there are a lot of value opportunities in our portfolio. We have companies that are operating with 20% free cash flow yields. So really finding that value in that yield as well. And the valuations, as we mentioned, are really cheap. and you can put it all together to create a portfolio with low volatility. So in that basis, we think that the area of front-end markets is really very attractive. And just to sum up our approach to that, as Sam's already mentioned, this is very active management. We have nowhere where we have to be invested. We do move the portfolio between countries fairly actively, and we will have zero weight at one point in a country where historically we've had more than 10%. We do believe in hard currency returns. It's no point giving you multiples of your value in kwacha or any other frontier market currency. This is really about returns in dollars, and that's why we talk a lot about macroeconomics, is really understanding those currency movements as well. And this is a fund that you could value if you saw a lot of holdings on a Bloomberg terminal or a similar source in about 30 seconds. Everything trades every day. Everything is liquid. We have, as we've said, that ability to move our portfolio. There's nothing that's illiquid in the portfolio. And the board do have a strategy for discount management, which they do look at, which I think feeds on to one of the questions around the discount. So just to talk about that discount management in a little bit more detail, the trust has been run since launch with a 5-year life. So the board has promised that there'll be ability for any investor to exit at NAV less costs on a 5-yearly basis. The second of those 5 years was last year, and we're very grateful that we got the ability to continue to run the fund for another 5 years, so another 4 years from now. But at the end of that period, there will be the ability for any investor to exit at NAV less costs in some format. Obviously, depending on how many people want to take that up will determine the format. We don't believe that we should have perpetual capital if we're not doing a good job, and investors should be able to get their money out. So that is the major discount control. The board has also undertaken buybacks when they feel that discount's very excessive. In terms of why the discount is increasing, why it's been moving around, I think I don't think we have a particularly strong view as to why it's increasing, but we do think that at current discount, the trust looks really attractive.
Yeah, I think it's just, I think there's a lot of fashion in discounts, and typically it just goes with momentum. As some of you may know, I'm named on another trust which is currently issuing shares that for many years traded at a discount. So I think it's a function of fashion. When one has strong performance and a strong investment theme, over time, discounts narrow and people do trade at premia. I think we've got a really interesting, unique story here. And I would expect that discount to reverse and once again go back to a premium. Exactly when that happens, it's impossible to know. Obviously, performance is everything, both of the markets on an absolute and relative basis. So we've reached sort of the point at which we're just going to take the questions that we can see and go through as many of these as we can as we go into the speed round. I can see Vietnam is the largest overweight to benchmark. Would you comment on Chinese manufacturers moving base to Vietnam and any concerns that may reverse?
Yeah, sure, I can comment on that. So we have seen a small amount of Chinese manufacturing moving to Vietnam. I think it's very much at the low value end. That's actually a trend that I think has been ongoing for probably the past 30 years, particularly, I think, accelerated more recently in the garment sector. But actually, it's not just China. A lot of the foreign direct investment that comes into Vietnam comes from Korea as well. Vietnam is an attractive place to manufacture given its young population that's been growing, but also very, very high, for example, PISA scores, so very good educational outcomes in Vietnam, which really stresses that benefit. I think we don't, given it's been quite incremental over the last 30 years, we don't see any, I don't have any significant concerns about a sort of a one-off reversal of that would be, that would hurt Vietnam a lot.
I would just add to that, given the political friction between China and the West, which I don't think is going to be diminishing, the desire to have supply chains outside China is only increasing. So I think it's very unlikely this will reverse. In fact, I would expect more and more supply chains to diversify outside China, not just to Vietnam, but garment manufacture going to Bangladesh, Pakistan, other countries that we invest in, and also elsewhere within Southeast Asia, whether that's Cambodia or Laos. So I think it's unlikely. We are big fans of Vietnam, but we don't have to be in Vietnam, and that's the beauty of this fund. The next question is that I agree that frontier markets are underinvested. Good, thank you, sir. But what percentage of a portfolio or percentage of one's equity should one be aiming for? I would definitely refer that question to one's IFA rather than giving an answer myself. What I would say is that one should think, depending at what stage of one's life one is in, whether one has need for capital short-term or long-term. It's really important to highlight this has to be a long-term investment. Do not invest in this fund if you're thinking about the returns over the next week or two or the next year or two. This has to be a long-term investment. That's the way we have set up this trust with a 5-year life. If we've done a bad job, as Emily said, we don't deserve your capital. But over 5 years, we think that's a good time period to think about investing in these markets. We are really excited about the medium, long-term outlook of these markets, especially compared to the developed world and on an absolute basis. And that is why we have a substantial portion of our own assets invested there. We have another question about a person who invested in spring 2018 and has lost money, and this compares unfavorably with another fund of another competitor. Obviously, we're never going to comment on individual competitors or on a group of competitors. There will be periods of time where we do better or worse than competitor funds. What I would say that over longer periods of time, I think our track record stands up very well vis-a-vis our index or vis-a-vis any one of our peers. I'm sorry to the individual concerned that we haven't done a good job over that particular period of time, but I think on the slide that Emily showed earlier, over the standard measurement periods, our numbers are quite good. Emily, over to you on ESG.
Thanks, Sam. So the next question is, how do you manage the ESG challenges in these countries? I think the first thing to say is we 100% agree with you that there are ESG challenges in all of these countries. The way we would define an emerging or frontier country, and we'd really lump the two together versus a developed market, is that they don't have the strength of either economic or political institution, as you would see in more developed markets, and hence, that's particularly on the governance side, I guess, but hence there can be significant challenges to investing in these countries. The way that ESG is integrated into all the work and research that we do, and the way we would approach it is looking for incrementally positive steps. And we have seen significant social and economic change in a number of the countries we're invested in over the lifetime of this fund.
I think that's really important to highlight. I mean, I've mentioned Saudi a couple of times. There's probably no country that we've been to, and I've been to, I think, something like 75 different countries of BlackRock. There's no country that we go to that's probably seen greater social change in the last decade than Saudi Arabia. Still a country, as I said earlier, that's got enormous social challenges, but really has come a very long way over that period of time. Can you hold shares in a country that's been promoted to MSCI Emerging Market Index?
Thanks, Sam. So we don't actually use the MSCI Frontier Markets universe as our universe. We can invest in any country which is either an emerging or a frontier market, which isn't the top largest 8 markets within emerging markets. So we can't invest in China, India, Korea, or Taiwan in Asia. We can't invest in Russia or South Africa, and we can't invest in Brazil and Mexico. Outside those 8 markets, we can invest anywhere that is an emerging market or below, obviously not developed markets as well. And
the reason why we did that is if we look at most investors, about somewhere between 80 and typically 90% of all emerging market investment is in those 8 countries. And the remaining, whatever it is, 20 countries in the emerging market index, 25 countries in the frontier market index, and about 130 other countries that aren't in any index at all, get absolutely or next to no attention. We refer to those countries as the forgotten 40, the forgotten 40 countries. So despite the 3 billion people, despite that 10% of world GDP, there's a very de minimis amount of focus on those. So we don't invest in the big 8, but we invest in absolutely everything else where we find risk-adjusted, interesting opportunities.
And we moved away from following the MSCI frontier markets as closely as we used to, just given the concentration of that index. And if you think back to the pie chart that Sam talked about of the number of countries that we're invested in, we really like to keep that diversification, that there isn't a single country that really dominates the risk we're taking in the portfolio. And we think that in a fund that does invest in frontier markets, that's really important. The next question is, are you invested in the fund yourselves? Well, let me speak for myself. Yes, it's a significant portion of the fund, of the invested wealth that I have.
And yes, from me as well. So that's an easy one. Are your countries being affected by inflation in the same way as developed countries? I'll start on that one. Inflation is a global phenomenon. The 2 points I'd like to make here, and perhaps Emily will flesh these out with greater accuracy. Number one, what we're experiencing in the US, UK, Germany today is inflation unlike anything we've seen for 30 years. Germany with inflation of 6%, the UK seeing various foodstuffs going up 20, 30%, inflation in general amongst a lot of Western Europe and the US is the 5 to 10%, depending where you're looking at. This is unprecedented in 30 years, and it'll be really interesting to see how central banks deal with that. Closing their eyes and pretending it's transitory was the initial approach. I think that's now on the wane. However, our countries have had inflation for years. Almost all our countries have had a higher level of inflation than 5 to 7% over the last 10, 20, 13, even 5 years. So the countries and the companies are much better set up to deal with inflation because they're used to it, unlike the companies and countries in Western Europe or the US. The other point to talk about inflation is that surprisingly, not all our countries are having inflation in the same way, to the extent where, remarkably, there are a whole collection of countries that one thinks of as highly inflationary countries that now have inflation below that of the US and below that of the UK. Emily?
Yeah, so thank you, Sam. I mean, and just to give some of the examples of that, if you to look at somewhere like Indonesia, I think inflation is currently running at 2%. And the Philippines actually has seen inflation decline. So it was at 4% before Christmas, was it in Q4, and I think it's come down to about 3%. So really not seeing those inflation pressures come through at all, especially in some of those countries. Both of those I've mentioned are in Southeast Asia, and really they're only, as I said before, only just starting to see that economic recovery that we've all been experiencing over the last 12, 18 months. So again, just in such a different place versus the Western world. Obviously, some markets actually are seeing the same pressures. So if you look at Eastern Europe, there's a number of countries there that are seeing quite significant pressures in terms of inflation. And really, I think that's for quite encouraging reasons, because what has happened in emerging Europe is post-COVID, they've gone straight back to where they were in 2019, which is benefiting from outsourcing from Europe because of the cheaper wages. And that has meant that these economies are doing really well, and they're seeing very, very strong economic growth, which is fueling that inflation. So that's quite an interesting place to be, I guess. That story that maybe is 20 years old of Eastern Europe really being the new Europe and really benefiting from being part of the EU actually really has come through as was forecast. Not that the markets have done as well as we would have hoped on the back of it, but therefore we're now finding really interesting opportunities there. Talking
about emerging Europe, I think it's important just to talk about the situation in Ukraine, even though there isn't a direct question on it as far as I can see, or possibly there is. Clearly, the situation in Ukraine is regrettable. We have limited exposure to Ukraine and zero exposure to Russia in this fund. We do not think, and we may be proved wrong by the end of this call, that there's going to be a wholesale invasion of the rest of Ukraine. We do think there may be more sanctions coming on individuals in Russia, but that's really not the concern of this fund. We think that some assets within Ukraine have been unfairly sold off because we don't think there's going to be a large war there, and at some stage we may have a greater exposure to Ukraine. It's not a very significant exposure today, but there may be some opportunities that get thrown up there. I think historically we've probably had as much as 5-7% at some stage historically in Ukraine. We have a much smaller weight than that today, but at the right level, we would be interested in investing more in Ukraine. Another question just related to Russia and Ukraine is sort of, in terms of global political challenges, is about the potential for China-Taiwan conflict. We do not think China-Taiwan conflict is likely in the near term, not in the sort of war sense. We do think economic conflict is likely, and we do think various statements about how terrible the other side is are also likely. That said, we don't invest directly in China, we don't invest directly in Taiwan, and going back to the point I made earlier, there's a clear desire by many Western companies to outsource away from China into Southeast Asia, which we should benefit from, and also a desire of countries like Taiwan and Korea to invest in Southeast Asia so they don't just become Chinese satellites. So a country like Indonesia plays a great game of attracting capital from Japan, from Taiwan, from China, and from Korea, because all of them would like to have Indonesia on their side, whatever that means. And so actually the competition that exists between China and Taiwan has a certain positive externality for parts of South and Southeast Asia. So just a comment on sort of live sort of political issues. The next question is, how much turnover?
Thank you very much for the question. So typically the turnover in the portfolio will be somewhere around 50–60% in a given year. Obviously that can really vary from some years when it's up at 70% to some years when it's right as low as 30%. If you think about around the 50% level, that would imply we have a holding period of around 2 years in the portfolio, which is probably very sort of at the bottom end of what we say of having that sort of medium term 3 to 5 year investment horizon. Now it's at the bottom end because actually the name turnover is much lower than the turnover in the portfolio. So we do move the fund in and out of countries, but actually within a given country, we will have the companies that we really think are the winners and the ones that we like on the longer term, that we think are the higher quality companies. And it will tend to be those that we come back to when we're reinvesting in a country. But because it's so important within frontier markets that we not only like the company, but we also like what's happening in the country, and bringing the two together, it does mean that that turnover is a bit higher than you would be expecting perhaps in some other portfolios with really that medium term horizon. But we think it's really important to be able to get those, to focus on the dollar returns as we talked about.
And the other point to highlight is we don't ever fall in love with our companies, and therefore when a share price goes up, we will often trim that position. There's a kind of mathematical aspect to this which is important, which actually is a portion of our turnover. Let us say we have 2% in a stock and the share price is 100. By the time that stock goes to 150, we will then, all other things being equal, have 3% in that stock. And the likelihood is that the upside with the share price at 150 is now smaller than it was when the share price was at 100, and therefore we will trim that stock, possibly only to, let's say, 100 basis points at that stage. And so a degree of the turnover is purely a function of share prices being volatile and moving around, and us wanting to risk control our portfolio so that we do not end up in the strange situation where as the share price goes up, we'd have a bigger and bigger weight in the stock, but the upside to our target price is actually falling. The next question is that we have no investment in India, but Greece qualifies. Is India not a frontier market? Or is your view that India is now too expensive? Well, actually, India is a fairly expensive market today. And at the margin in our emerging market funds, we've been reducing our exposure. However, India is not actually investable at all for this fund. As Emily highlighted earlier, the big 8 emerging market countries that attract about 90% of all emerging market funds are not what we're focused on. And therefore, India is not and will not be investable in this fund. Even if we did like India, which, as I said, we're not so keen on it today, we will not be investing there. Greece, however, is part of the emerging market index and is not one of the big 8, and therefore we do invest there. We've had significant wins investing in Greek financials over the last couple of years, investing in them when no one else was interested in them, and they've actually done fairly well. Back to Emily.
I think when we think of frontier markets as well, there's kind of 2 aspects to that. And one of them, in the case of Greece, would be that the market we think is very overlooked. So it's a very small percentage of emerging market benchmarks. So although it's perhaps more developed than you would be expecting from a frontier market, in terms of GDP per capita, I think in terms of the development of the capital markets, it's still, it hasn't caught up with the big emerging markets, and hence that's why it's interesting.
What are your views on Vietnam? Increasing or decreasing your current exposure is the question.
Thanks, Sam. So Vietnam, we've already mentioned a little bit. We continue to like Vietnam. I think what Vietnam has been able to do really well is prolong its economic cycle. Most frontier markets are very cyclical. Vietnam, because of the extent of international investment that it has attracted, has been able to continue to grow its exports very fast over probably 10, 15 years now. And that's really unusual to be able to do it for such a long extended period of time. It really speaks to the attractiveness of Vietnam as a manufacturing destination. As things stand, we've decreased our exposure to Vietnam over the last year a little bit, and that's really just because the stocks we've owned there have done really well. It's one of the markets over the last 2 or 3 years, I think, that's the strongest performing across frontier markets. And as a result of that, we have taken some exposure out. I think there's one name we've taken out entirely. But in terms of, but it still continues to look like a pretty attractive investment destination.
Are you worried about the newly elected governments in Chile and Peru threats to nationalize mining companies being copied by other countries? In fact, are we worried about it happening in Chile and Peru as well? Yes.
Yes, of course.
Yes. Look, I think it's a function of left-wing governments globally that, you know, natural resources, they can't move out of the country, and therefore there's always a risk of increased regulation, increased taxation, and in some cases nationalization. We do not think that the nationalization that might take place in Chile or Peru will be confiscation, which is different to nationalization, but clearly there is a risk both in Chile and Peru, and that being copied beyond. Our exposure to sort of assets where that is a significant risk is fairly small. Of course, it does exist. And in general, our exposure to natural resources, be it energy or metals and mining, is rarely more than 20% of the fund, as you can see on one of the later slides. So although we are excited by some of the new energy materials that we invest in Latin America, it's not a dominant portion of our fund. We follow the political risks extremely closely, and we would not be surprised if at some stage there was nationalization, but probably not confiscation. Emily?
Yeah, I think it's something that rears its head in various countries. I mean, at least every few years, and especially when commodity prices go up, which they have done over the past few years. And I think, as Sam said, that is always a time when the conversation comes up again. And it's really important that we are on top of political developments in every single one of these countries, which I think just goes back to how unscalable it is to run these funds, because you need to be on top of the political and the economic developments in 30 different countries.
Yeah, and that's really important. Our normal line on that is when the currency goes down 10%, the market goes down 20%, and you lose 30% in a few days. And saying we've got a great company is completely irrelevant when you lose 30% in dollar terms. The next question is slightly concerning. According to SharePad, ! You're currently holding 18.9% in cash. Is that correct? Absolutely not. Currently, as per the latest release of the stock exchange, which I think went out in the last couple of the days, you can see at the end of January, I think we were exposed by about 106%. I stand to be corrected on the exact number, but somewhere between 104 and 107%. So I never know. There are a couple of data providers that do some very strange things with the data that we provide them, or the data that they take from various places. No, we do not have 19% cash, and in fact, exactly the reverse. We are modestly leveraged. We have a potential to leverage up to 115%. So we're kind of mid-level leverage. We're positive on what we're seeing. We do not have 19% of cash. Is Kazakhstan recovering? Are you aware of investing further in ex-Soviet bloc countries? So the first point to say that is we, as was highlighted by Emily, we spent a lot of time going to our countries and our companies. And in Q4, we began traveling again for the first time in about 18 months. And our colleague went and saw the most senior people in Kazakhstan late in December. And sure enough, just after he went there was an attempted coup. He was not responsible for it, let us be clear. So Kazakhstan is recovering. There's a degree of stability there. I'm sure there will be more changes at some of the companies in that country. We have significant exposure to Kazakhstan. We are not wary of investing in general in further ex-Soviet bloc countries. And in fact, I was in Uzbekistan in Q4 last year looking for opportunities there. So we are wary of investing in all emerging and frontier market countries, not just ex-Soviet bloc countries. It would be ridiculous to think that these countries in general are safe places to invest. The question is the price of risk in any of these countries. And as we kind of mentioned earlier, the most dangerous thing is when people think there is no risk in these countries, or when your grandma, aunt, taxi driver says, oh, that's a great place to invest. That always scares us. So we are wary of investing in all countries, not just ex-Soviet bloc countries, but we think there's some very interesting opportunities in Kazakhstan today, and even in Uzbekistan in a few years' time. The next question is, do you visit the countries you invest in when you're able to? And how do you research as a wide variety of markets in sufficient depth? Emily, you provide sufficient depth.
Thanks. I'm not sure what that implies. I'm very wide or something. Very tall. We do visit them, so apologies. We do visit the countries as much as we can when we're able to. And as I tried to highlight, we've already started to travel again because we do just feel that it's really, really important. And what you can gain from a face-to-face conversation is so much more than what you can gain for a screen. As I'm sure you are all experiencing at the moment, you prefer to be in a, well, maybe not in a room with us, but it does help facilitate conversation. It is really, really important. And how do we manage to do it? We have a team of 30 analysts. It's a really big team that work all across emerging and frontier markets. And we think that having the ability to call on a large number of analysts, and also that we are integrated within that emerging markets team. So to call on the expertise, that we can speak to the China side of the analysts when we're looking at, the investment that's going into Vietnam, and those synergies are hugely important. As Sam mentioned, to have the language skills, I think our team speaks 18 languages. It's nowhere near enough we need, but it does at least start to help in that regard. And obviously the length of time, the amount of grey hair that Sam has, and the length of time we've been investing in these markets does really help to provide some of that knowledge. But there's always more that we can learn, and I think what we love about the job is that, as you noticed, perhaps you have to speak quickly to be able to get all the information in.
But we, as you can see, we love this job. We've been doing it for a long, long time, and obviously that has a great advantage. Having a big team and a lot of experience really is very valuable, especially when most people sort of in the market don't have that longevity, experience of cycles, or experience of company management and governance. What percentage of your investable markets have foreign ownership limits? How do you manage this?
It's an interesting one. So a number of our markets have foreign ownership limits. I think it would be between 6 and 10 probably, but actually there's only one where they're noticeably binding, which would be in Vietnam, which is, I'm sure, the market where you've heard about them. We own a couple of companies that are foreign ownership limits. It's one of the benefits of having managed the trust for a long time, that we were able to buy some of those positions a long time ago, and they have done well. I think it's a function of understanding foreign ownership limits, understanding how any market trades, and there are a lot of nuances to the trading, how you trade in all these different countries that we need to understand, and we're really benefit from the huge back office team that we have at BlackRock, that they're able to put that set up to understand legal frameworks, dividends, withholding tax, etc., in all the countries where we're investing.
And one of the big changes is, as Emily was indicating, Vietnam has still got an issue with foreign ownership limits. If we go back 10 years, Qatar, Saudi Arabia, UAE, and others all had real issues. Certain companies we couldn't invest. Those foreign ownership limits have gradually been removed, reduced, or gone, in multiple other countries. So Vietnam remains a challenge, but the vast majority of other countries, it's no longer a real problem for us. What is your cost percentage before and after trading costs? Do you have a performance fee?
Charlie, I don't know if you're able to jump in with the exact numbers here.
Thank you for your question, Bruce. So the management fee is 1.1% of the gross assets of the fund. Ongoing charges, including management fee, is 1.4%, and this year there has been a performance fee, as shown in the annual report to September 2021, which altogether adds up to 2.4%. So the performance fee is a 10% outperformance of the benchmark, but it's since inception. So performance is payable annually, less any performance fee that has been paid out in the past, but it has to exceed prior year performance for it to be accumulated.
And I think it's worth highlighting that, since someone asked about competitive funds earlier, when we've looked around at the price for frontier markets in the open-ended space, typically they're slightly higher than what we've been charging. The next question is, do you hedge the currencies of the countries you invest in? And the answer is no. And the reason why we do not hedge the currencies is, other than it goes back to a point that I made earlier, which is that if we don't like a country, and we don't like a country because of the macroeconomics, we don't like a country because of the politics, we don't like a country because of the currency, we don't want to be there. Because when a currency goes down 10%, there's a complete beta to the market, unlike in the UK market, where that's not the case, where it's the reverse. Currency goes down 10, market goes down 20. So if we are negative on a currency, we do not want to have any exposure to that country. And that's a really important point. So we don't want to hedge the currencies because we just don't want to be there at all. So other than the cost associated with hedging the currencies, it probably would be contrary to what we'd want to achieve. As far as I can see, there are no more questions, but I may be wrong. in that assumption. And I really should be looking somewhere else. Emily, is there anything else I should be looking at? Anyone else want to ask a last minute question? Just
Hi,
to make
Sam.
sure. Yes.
Emily. Yes, I'll ask one more question. Which do you think are the most attractive investment destinations in Africa?
Emily.
Yeah, so we're perhaps somewhat unusual in that over the last 15 years, we've probably been more at the Afro-pessimistic than Afro-positive end of the spectrum. And really, I think, always with investments, it's about, perception and then what the reality is versus those expectations. And I think if we were to go back 10, 15 years, there was a lot of talk about the investment opportunities that must be there in Africa. And the perception was that this was really exciting, a really hot area, which was really different to the reality that we saw on the ground, which is actually the stock markets tend to be still very, very fragmented. And the scale of companies that are listed on the stock markets is still very, very small. And if you think about the population dynamics and the GDP of each individual country, I think it was always Guinea-Bissau that Sam often gives the example, actually has a GDP that's lower than the London borough of Hounslow. And so really, even if you have the leading company in that country, the scale of it is still very, very small. And we've not seen many pan-African champions really emerge so far. And that's not that surprising, given that we're talking about 52 legal jurisdictions and multiple times that number of languages. So it's a really difficult place to do business. Having said that, I think the more that we have come through and come to the point where a lot of these challenges are now being recognized, the more then actually that probably does mean that there are companies that are starting to present some opportunities. And there are areas, Nigeria has a population of 260 million, that provides a lot of scale. The East African hub and some of what the deregulation they've done to allow companies to operate, cross-border there actually creates quite a significant marketplace. And again, not just the derating we've had in the Egyptian marketplace, means that some of the companies there are starting to look really cheap. So more and more we are starting to see opportunities. The currency restrictions we still have in place in Nigeria, so that currency isn't freely trading, is a very significant hindrance. And obviously, we don't want to be in Hotel California where you can put your money in and you can't get it out. So
I think it's really important to bring everything to a close. When we invest, we're excited by our markets. We really want to be passionate about these markets, but we are also dispassionate about how we take our clients' money and invest it. We are not just thinking there's blue sky everywhere over all these markets and saying everything is wonderful. That's great for marketing, but it's probably terrible for clients longer term. So when we look across the range of these markets, they've got growth, they've got yield, they've got enormous valuation support, and we've got, as Emily said earlier, discount control, and we're thinking about hard currency returns. So the overall package is great, but to fall in love with any one of these countries or any one of these regions on a long-term basis can be very damaging, can seriously damage your wealth. So one has to think about things in a rational, dispassionate manner to ensure the best risk-adjusted risk-adjusted returns for all clients.
Thanks very much, Emily, Sam. That was extremely interesting, and hopefully our delegates all enjoyed that. So thanks very much for your time and answers to the questions. It was very comprehensive.